To the thoughtful investor, the idea of timing the market presents an almost irresistible allure. It is the simple, elegant notion of buying stocks precisely when they are at their lowest point and selling them just as they reach their peak. The goal is to capture all of the upside while neatly sidestepping any of the painful downturns. Many individuals believe that with enough research, a keen eye on the news, or perhaps a special kind of intuition, they can master this art. They see it as a way to generate superior returns to outsmart the collective wisdom of the millions of other participants who make up the market every single day. This is the grand promise of market timing. However, a lifetime of experience and an overwhelming body of evidence. This promise is deeply and fundamentally flawed. This essay explains why consistent market timing is more likely to disappoint than build wealth. The temptation to engage in this speculative dance is understandable. Financial news channels are filled with confident prognosticators who declare with certainty that a crash is imminent or that a new bull market is just getting started. We are bombarded with stories of traders who made a fortune on a single, perfectly timed decision, making it seem like a repeatable skill. This creates a powerful narrative that anyone should be making tactical moves. People are driven by greed and the desire to seize extraordinary profits, and the terror of watching hard-earned capital diminish. These forces compel investors to believe they must act. But the reality of the market is far more complex and chaotic than these narratives suggest. Movements result from countless unpredictable factors, from geopolitical events and economic data releases to shifts in consumer sentiment and technological breakthroughs. The most compelling argument against market timing does not come from abstract theory, but from simple, cold arithmetic. Long-term returns are not delivered in a smooth line. They are concentrated in a surprisingly small number of exceptionally strong days. Missing these key days devastates long-run growth, and you cannot circle these days on a calendar. They arrive unannounced, often during peak pessimism and volatility. Consider a foundational study analyzing decades of market data. One analysis found that over 20 years, buy and hold earns substantial annualized returns. Miss just the 10 best days and total return can be slashed by more than half. Miss the best 20 or 30 days and a positive return can fall to nearly zero, or a loss. The market's best days often occur near its worst days. Selling after a fall to wait it out likely misses the strongest leg of the recovery. Volatility describes day-to-day and minute-to-minute price fluctuations. It is a natural and unavoidable feature of stocks. Timers see it as opportunity to buy low and sell high during rallies. Long-term investors view it as the price of admission for superior long-run returns over safer assets like bonds and cash. The error is assuming volatility is predictable. Shocks are triggered by unexpected news, a surprising economic report, a sudden international conflict, a corporate scandal. Markets react with incredible speed, often in minutes or hours. By the time most investors process and act, the opportunity is gone. Fear screams sell now at lows. Greed whispers buy more at highs. Acting against these impulses requires rare emotional discipline. One insidious enemy of the market timer is transaction costs. Every trade has a cost. Small costs compound into a large drag, like a small leak that sinks a ship over time. Commissions have fallen, but still add up for active traders. Beyond commissions is the bid-ask spread. That gap is an immediate, guaranteed loss on round trips. Selling at a profit triggers taxes. Short-term gains are taxed at higher ordinary rates. Holding over a year benefits from lower rates. The more you trade, the more you enrich your broker and the tax collector, and the less you keep for yourself. Buy and hold minimizes friction, letting compounding work. Beyond math and costs, the greatest obstacle lies within. We are not perfectly rational calculating machines. We are emotional, influenced by powerful biases. Mental shortcuts helped our ancestors but are ill-suited to investing. Biases make us buy high and sell low. The two most powerful emotions are fear and greed. Bull markets foster greed and FOMO, drawing buyers at high valuations. Declines trigger fear, causing investors to lock in losses near bottoms. We feel safer in crowds, reinforcing buy high, sell low. Timing requires standing apart, emotionally taxing and unnatural. Overconfidence after a few wins begets riskier bets, ignoring luck's role. When luck fades, losses can be catastrophic. Given the obstacles to timing, what should a prudent investor do? Embrace elegant simplicity. Buy and hold. Purchase a broadly diversified portfolio, primarily low-cost index funds representing the market, and hold through thick and thin. Aim to capture the market's long-run return. Over time, earnings growth and dividends drive returns. Own a piece of businesses. Their ingenuity becomes yours. Structure reduces costs and taxes. Less trading keeps more money compounding. The most powerful force in finance. Buy and hold harnesses compounding over a lifetime. It frees you from forecasting and from daily worry about tomorrow, next week, or next month. Focus on 10, 20, 30 years, aligned with long-term progress. Many struggle less with what to buy than when to invest. Fear of investing a lump sum before a downturn is common. Use dollar-cost averaging. Invest a fixed amount at set intervals, for example, $500 every month, regardless of market conditions. High prices buy fewer shares. Low prices buy more. Over time, it lowers average cost compared to guessing entries. It leans into declines without fear-driven decisions. It prevents chasing perfect timing so you don't stay sidelined as markets rise. Ideal for paycheck investing via workplace plans. Automation resists halting in panics or surging in euphoria. You participate continuously in the long-term uptrend while smoothing the bumps along the way. Buy and hold does not mean buying one stock and hoping. The cornerstone is diversification. Don't put all your eggs in one basket. Spread across assets to reduce risk and smooth returns. Stocks drive growth. High-quality bonds add stability and income. Bonds often hold value when stocks fall. Own hundreds or thousands via broad market index funds. Diversify across geographies, U.S. and international, and across company sizes, large, mid, and small. Own a slice of the global economy. Set an allocation aligned to goals and risk, e.g., 60-40. As markets move, allocations drift. Rebalancing trims what's expensive and adds to what's cheap. It's mechanical, non-emotional, and manages risk. Combine diversification and rebalancing to withstand turbulence and stay on track. The evidence against market timing is clear, consistent, overwhelming. The promise is appealing, but reality is a minefield of challenges. Missed best days, hidden costs and taxes, and emotional biases lead us astray. The pursuit of perfect timing is a fool's errand. It distracts from the simple, proven path. Success isn't about brilliant moves, but avoiding foolish mistakes. Own a broadly diversified, low-cost portfolio of stocks and bonds that reflect your goals. Invest regularly through dollar-cost averaging, turning volatility into a friend. Rebalance periodically to keep risk in check. Most importantly, hold on and let compounding work over decades. Don't hunt the needle. Buy the haystack.